Now what you see in front of you is the DuPont analysis that you are familiar with already. That has been in the first versions of Probe MMX. It's always been there. And the way that it works, just to refresh your memories, is the DuPont analysis is just return on equity as the end result of the process, which is basically the figure that the client is interested in. And DuPont analysis shows you how return on equity is built up through return on assets and debt equity ratio. If you just follow the lines there, then you can see how it's built up. And that has been a very useful tool to identify fluctuations and identify changes in the business and changes in the way that the business operates and effectively how the business has made money for its shareholders, hence the focus on return on equity. But we have now expanded that a little bit, because what you can see at the top there, if you can just look at the top of my screen there, you can see that there are a few more tabs. There's tabs for, if I can start on the left, developing expectations and analytical procedures. And we start with the statement of financial position, or the balance sheet, and then after that we go through exactly the same process again, developing expectations and analytical procedures, but in this case for the statement of comprehensive income, or the income statement. So if I can focus on the first one, because as you will know, the idea to develop, to do analytical review at planning stage is, well, not only at planning stage, I suppose all analytical review is, first of all, you have to develop expectations. You have to decide, what do we expect this figure to be in the end? And then once you have developed that expectation, and go through a number of other processes, how accurate is the expectation, and look at internal controls and things like that. But once you have done all of that, then you go and do the analytical procedures, which is to identify unusual fluctuations, variances, etc., obtain reasons, and then obviously, as this is the planning analytical review, to tailor your audit program accordingly. So let's start with the developing of expectations, and I'm just going to show you the property, plant and equipment line, the assets basically. Property, plant and equipment, you can see last year we had 185,418 Rand. Now, first of all, as you will note, there is only a column for 2010 figures. That's last year's figures. You can activate another column, the 2009 figures, and that is done in your probe firm settings. The firm settings that are set up on a firm level, where you can decide if you want to look at prior year columns or prior year -1 as well. I'm not going to demonstrate it because that is something that is set up on a firm level, but just to show you that it can be done at this stage. Once we've done that, you can now develop your expectations. How do you develop your expectations? And if you notice, I click here on the arrow button and it gives me 3 options. I can either form my expectation in the shape of an amount, just simply put an amount down. So property, plant, equipment last year was 185,000. I expect 200,000 Rand this year. Then in that case, I simply select the amount and I put that in. Or I can say I expect property, plant and equipment to increase by a certain percentage, and I can put the percentage in, or I can expect it to change by a certain round amount. Let me demonstrate. If I say I expect property, plant and equipment to increase by 30%, that's what I have got on the screen at the moment. Then I put the percentage in. In this case, for some reason, the user decided that property, plant and equipment was supposed to increase by 30%, and the program automatically calculates that the expectation for 2011 is 244,043 Rand. Sorry, 241,043 Rand. Otherwise, and I suppose for property, plant and equipment, this is more appropriate, you would simply estimate the amount. I know that the client has purchased a vehicle and they have sold another vehicle and they have depreciated. So I know that property, plant and equipment in my mind should be roughly 250,000 Rand. And I simply type that in. It's simply an amount that you have to type in. You type in positive amounts for debits and negative amounts for credits. And otherwise, as I showed you, the percentage change, or you can show a Rand change. So let's go, for example, down to the trade and other receivables section, or let's say cash and cash equivalents. You can see the user has estimated a Rand change. So in this case, last year was just over 1 million Rand of cash, and obviously the user or the client, after discussions with the client, they thought that we had quite a good year. We expect our cash to increase by 500,000 Rand. You can see there, by 500,000 Rand. So in this case, I simply said Rand change, 500,000 Rand, Expectation, therefore, is 1.5 million rand that is developed, that is given to us automatically. And then if we carry on, so that's why you carry on through the entire income statement. You can see here in share capital, I just simply put in an amount and I just estimated the amount. And then we go to income statement, then we go to the income statement over there, sorry, we click on the income statement over there and you do exactly the same exercise there. So here I can say, for example, I expect my sales to have gone up by inflation only, so I just make it 6% and it does that. Cost of sales, I expect the same change. Okay, I think you get the picture. Once we have formed expectations, we are now ready to go and do the analytical review. The actual analytical review is done on these tabs, the analytical procedures. So just have a look at when I click on that tab, I see a different view. Back to the back to the balance sheet again. So it's the same figures, but a different view. I see 2010. I see my expectation for 2011, but then it shows me the actual figure for 2011. So I expected it to be 250,000, and in fact it's only 208,000. The expected change was 250,000 Rand, and the actual change was 12.19%. The amount increased by 12%, which in this case is not all that important. What is important is the fact that we are way off the expectation. So then I would here put in my comments, why did it a comment or a question or a risk or whatever the case may be, and then you simply go and record. In this case I'm on the review template, so I can record that this item is likely to be misstated. If I was on the audit template, I would have been able to record a risk in a similar way. It's either a risk or item that is likely to be misstated, and then you carry on in the way that you are used to. So the difficulty that we've always had with the DuPont analysis and all the other models that we've been using is that it was very difficult to record a risk, or not difficult, but a little bit onerous, to record a risk, click on it, and you can link the risk back. Now you can do all of that. So now you can see your expectations, you can see your comments, you can see your risk, you can even put in there what your audit response is going to be. In this case, I would say, in this case, I would tell the team what we should do, how we should respond to it. And then obviously I will record the risk, and I can put the reference in here as to where I responded to that risk. Okay, and that way you go through the entire document and you do your analytical review in a much more structured way and in a much more formal way. You can document your expectations and why you go add those expectations. You can then do the analytical procedures in a structured way, and you can then respond to it in a structured, in a controlled manner. The other tabs are, I'm not going to go through that. You understand what that is by now, I think. And then right at the end, we are back to the DuPont analysis, which now puts everything in perspective. Also, what we do is you can see that it calculates totals for you. So once you have formed your expectations, Probe is actually calculating if we can put it, a forecast income statement and a forecast balance sheet. So if you expected your gross profit or loss to be X and the gross profit or loss is actually Y, then you can even comment on that level. So you now have not only on a lead schedule level, you have also on your financial statement line item level, where you can comment on the line items that the user will see, and you will consider it that way and break it down into the steps that have made it up. This is in the July 2012 release of the template.